China quietly pulled the rug out from under Moscow's fragile economic lifeline, and the consequences are enormous. It's not an overstatement. Beijing's recent decision to halt an informal subsidy scheme that propped up Russian metal exports has ripped away a critical revenue stream. In this breakdown, I'll explain what changed, how those hidden rebates kept Russia afloat, and why Putin suddenly looks exposed and vulnerable. First, the mechanics. For years, Chinese buyers effectively received backdoor discounts when purchasing Russian copper and nickel. These weren't public policies or headline-grabbing deals. They operated as concealed rebates and price supports that made Russian metal artificially cheap for Chinese industry. The arrangement was straightforward. Chinese processors bought raw metal at favorable terms, sold at global prices, and pocketed the margin. For Moscow, the effect was life-saving. Smelters kept running, miners got paid, and export receipts kept flowing despite sanctions from the West. When Europe and the US shut Russian metal out of primary markets, with exchanges like the LME and CME banning Russian stock, China became the only major market still taking large volumes. More than a buyer, Beijing quietly underwrote the trade with financial incentives that converted otherwise uncompetitive tons into viable exports. That covert support became the backbone of Russia's metals sector. So when Beijing stopped offering those rebates in September, it did far more than tweak terms. It cut the lifeline. The scale of what's at stake is plain in the numbers. Earlier this year, Russian copper exports to China jumped by roughly 2/3 and nickel volumes more than doubled compared with the prior year. Russian aluminum frequently traded at huge discounts, sometimes more than 20% below global benchmarks. Those statistics reveal how powerful Beijing's implicit backing has been. It kept factories humming and kept Moscow's export statistics appearing robust even while the rest of the world closed its doors. With the subsidies gone, China's customers started looking elsewhere. Southeast Asia, Africa, and Latin America began to look more attractive. Cheaper labor, untapped reserves, and lower geopolitical risk. Once buyers switch supply chains, luring them back is difficult. So Russian metal is piling up in warehouses. Deals are harder to close, and margins are thinning. For an economy already strained by war spending and sanctions, this is a structural hit. This cut is not just bad timing. It strikes at the heart of Moscow's fiscal model. Metals, copper, nickel, aluminum, generated tens of billions in revenue last year and filled gaps left by weakened energy receipts. Those export flows have helped blunt ruble pressure, finance regional subsidies, and keep factories solvent. Analysts now expect metals income to fall sharply. Some estimates suggest a 20 to 30% drop by year-end, which translates into a very large hole in government revenue. That isn't merely an accounting glitch. It forces stark trade-offs for the Kremlin between defense budgets, pensions, social services, and domestic subsidies. The human impact will be concentrated in mining towns and smelting centers. Areas built around copper and nickel processing will feel layoffs first. Local budgets will tighten, small businesses will suffer, and migration pressures will grow as skilled workers seek better opportunities abroad. Factories that once ran 24/7 will idle or reduce shifts. Over time, towns that depend on metals production risk economic stagnation and demographic decline. Why did China pull back? Officially, there's silence, but the logic is consistent with Beijing's priorities. China's leadership isn't interested in underwriting a partner that Western sanctions have isolated and destabilized. With its own growth challenges, Beijing prefers stable, diversified supply chains and fewer political risks. Cutting these implicit supports shields Chinese industry from price volatility and reputational risk, while giving Chinese buyers freedom to source from more reliable or cheaper suppliers elsewhere. Put plainly, China can afford to be picky, Russia cannot. There's also an implied strategic calculation. China can still buy Russian metals, now on market terms, but it no longer needs to prop up uncompetitive volumes. The shift signals a pragmatic move. reduce exposure to a sanctioned economy, avoid drawing greater financial or political scrutiny, and pivot procurement toward a wider supplier base. The timing also reflects Beijing's broader risk calculus. With U.S. policy tightening on sanction evasion, Chinese companies face higher compliance risks if they become overt backstops for Moscow's beaten industries. The consequences ripple across global commodity markets. Russia once supplied a hefty share of refined nickel and copper. When Chinese demand cooled and Russian shipments shrank, market dynamics shifted. Some categories saw tightening. Others felt downward pressure as lower-grade Russian lots were sold at steep discounts. Traders in London and Singapore began to price that uncertainty in, benchmark spreads widened, and procurement teams scrambled to guarantee feedstock quality. Meanwhile, alternative suppliers in Chile, Indonesia, and Peru gained negotiating leverage. Buyers rebalanced their portfolios, and long-term contracts were renegotiated. For other producers, this is a mixed bag. Some welcome the new business and better terms. Others face unpredictable price swings as lower-grade, cheaper Russian metal undercuts premium products. Global supply chains that planned months ahead suddenly had to adjust, complicating manufacturing forecasts and investment decisions. Moscow's room to respond is limited. It isn't in a position to coerce Beijing or demand restoration of opaque subsidy channels. Russia's economic bargaining power has diminished. Sanctions limit its access to global finance, and many trading partners are cautious. That asymmetric dependency is the core problem. China can diversify away. Russia cannot readily replace China as a buyer. Moscow faces a stark choice: deepen domestic subsidies to keep plants alive, accept even lower prices and eroding margins, or see inventories accumulate and factories shut. Each option carries heavy costs. Subsidizing industry further would stress the budget at a moment when war costs are already ballooning. Selling at steep discounts erodes long-term competitiveness and revenue. Letting plants stop harms regional economies and removes industrial capacity that will be costly to rebuild later. Politically, this shift is damaging to the Kremlin's narrative. The leadership has long touted the pivot to the east as proof that Russia can withstand Western isolation. Beijing's quiet withdrawal undermines that image. Trade figures and official messaging can't hide the structural dependence. Domestic audiences will notice falling production, rising unemployment in mining regions, and pressure on public finances. The propaganda spin may try to frame this as a temporary adjustment or a technical issue, but the structural reality is unmistakable. Beyond economics, this move signals a shift in how Beijing calculates its geopolitical ties. China has long balanced pragmatic cooperation with Russia against broader strategic aims, securing stable supplies, protecting its own industries, and avoiding entanglements that invite Western blowback. Pulling subsidies is an exercise in risk reduction. It preserves Chinese options while subtly nudging Moscow to confront the costs of its strategic choices. The technological and industrial cooperation that once looked promising between the two countries is cooling too. High-end tech partnerships in robotics, advanced chips, or dual-use systems become harder to sustain when the partner's economy and political risk profile deteriorates. Chinese firms now face regulatory headwinds and reputational exposure if they shift too visibly into sanctioned work with Russia. That constrains future collaboration in sensitive sectors. Russia's alternatives are limited and imperfect. It can try to redirect exports to smaller buyers, countries in Africa, Latin America, or parts of Asia. But those markets often offer lower prices and smaller volumes. It can seek barter arrangements or swap deals, but these are administratively complex and don't replace hard currency revenue. It can boost domestic processing or move up the value chain, but that requires capital, technology, and time. Things Russian industry lacks at the necessary scale today. The broader geopolitical picture is sobering for Moscow. As China tightens its selectivity, other potential partners become more cautious too. India, Gulf states, and others watch the sanctions regime and weigh reputational and financial risks. Even friendly countries hesitate when the geopolitical cost of deepening ties rises. The net effect, Russia's pool of willing, deep-pocketed trade partners shrinks. Economically painful as it is, this doesn't mean Russia collapses overnight. It can limp along, reprioritize budgets, and reshuffle trade flows. But the cumulative effect matters. Shrinking export revenue, worsening terms of trade, and higher domestic inflation will squeeze living standards and taxpayer tolerance. Over time, the pressure compounds. Less investment, slower growth, and greater social strain. What happens next matters strategically. Moscow may try to paper over the shortfall with domestic subsidies, more aggressive resource sales at discounted prices, or finding niche buyers willing to take on risk. Any of those paths carries trade-offs: deepening fiscal stress, aggravating long-term market credibility, or accepting lower returns. For Beijing, the move is low risk and high reward. It reduces exposure to sanctions risk, strengthens negotiating leverage in commodity markets, and positions China to deepen ties with alternate suppliers. Politically, it allows China to emphasize pragmatic self-interest rather than overt alliance building with a partner whose strategic choices now create downsides. In sum, the quiet end of those Chinese rebate mechanisms is a structural blow to Russia's sanctions-era survival strategy. It strips away a key buffer for an embattled metals sector, tightens fiscal pressure on the Kremlin, and accelerates a reorientation of global commodity flows. The larger lesson is clear. In an interconnected world, strategic dependencies cut both ways. And when the larger economy decides it's time to protect its own interests, the smaller partner can be left to weather the fallout.